Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
I think with the current political climate, I think definitely understanding what sort of insurance and what sort of hedging you could do for portfolios, but also understanding how times like this when volatility is starting to return to the market can be great opportunities for option traders because premiums can jump quite a bit, and that can be when we as option traders, and I do this myself, can look for greater chances to pick up good premium on stocks that we'd like to own.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What's a derivative and how can they be used in your investment strategy? How have markets evolved since the days of open outcry trading floors? Joining me in this episode is someone who's just celebrated 35 years in the industry. G'day, Haydn.
G'day, Phil. How you going?
Very well, thank you. Thank you very much for joining me on the podcast.
No, fantastic. Happy to be here.
Haydn Froggatt is the Director, Head of Desk at iInvest Trading and Advisory, a boutique financial services firm offering stockbroking and wealth management services. So I do spend a little bit of time, but I haven't done this for a couple of years, where I want to look back on what it used to be like on the old-fashioned trading floors. What was it like that first morning that you walked in for the first time into the industry? What was it like in those days?
Yeah, Phil, certainly a long time ago. I first started on the floor after the equity market had stopped trading. It had gone to screen trading. So I started on what was the options floor. It took over the original equity floor, so 20 Bond Street, I think it was in Sydney, and started down there, sort of early 1990. And it was amazing to learn all about equity markets and from a lot of the old guys that have been around for a long time, how the option market had evolved. It started in Australia in about 1978, how it had grown and how options could be used, and learning it from the guys that were providing the pricing for trading. So learning from guys that really understood the in-depth component of options. The big benefits, I think, as we moved forward in options and the evolution of market in Australia was once the floor closed, going to screen trading, while many of us weren't confident about it, it really ended up being opening up the market, I think, for clients to get involved because pricing was so much easier to understand. When we were a floor-based market, you had to go chasing a price from market makers to really get an understanding of where the price would be. Going to the screen system, you were able to request quotes via the computer system and they would appear in front of you. So that made the whole thing much more open to retail investing.
So was it the old-fashioned floor with the chalkboards on the sides of the walls?
No, when I started, we'd gone to we were a floor-based screen trading environment. So it was open outcry, but then the transactions were all done via computer in front of the trading pit.
Okay, so just getting back to where you are today, and
Yep.
I can see that my autocorrector said online grocer rather than online broker.
I did see that, yes.
Yeah, and I just realised that. So what's the difference between an online broker and a full-service broker?
Look, I suppose the big difference is a full-service broker is someone that's really there to help you and talk you through what you're looking for investments, to take into account your goals, your investment understanding, your capital requirements, and really what your investment parameters are. Versus utilising an online broker, you are basically making those decisions yourself. We, as a broker that offers the full-service component, will probably have better access to research, really have a better feel for what the market is doing, and maybe able to help give you tips and ideas about executing transactions, as well as helping you build a portfolio that will suit your needs and desires.
So there's two kind of services that you offer, one are the derivatives and options and so forth, but there's also direct investment in the share market. What is it that you look for in a particular company?
Look, for me, I sort of focus on building portfolios for clients. I probably am not looking for in the equity market for short-term trading as much. For me, it's more building portfolios that are going to stand a sort of a 5-year sort of period, and looking for whether it be a growth portfolio or an income-focused portfolio or a mix of both. So a lot of that will depend on the investor's requirements, and then we look to build a portfolio around that, taking into account market trends and research ideas and price targets and things like that.
So are you looking basically in the big end of the market, or do you also look at small caps as well?
Look, probably we're focusing more for a portfolio is probably more the larger caps, probably top 200, really focusing on companies that have got solid track records, good research parameters around them and good research reports, and are going to give when we're building a portfolio for someone who is looking for more that longer term share market investment, really companies that are going to survive and thrive over the period.
Are there any particular metrics that you rely on?
Certainly we'll be looking at earnings per share growth, yield numbers. Certainly that's something you definitely focus on. Many investors, certainly guys in super, are looking for that yield component. So looking at what yields are being offered and then managing the risk around that. So really knowing where the right sort of yield is for the right sector. I've always looked at the banking sector and sort of looked at if you're buying a bank at a yield under what the government or the Reserve Bank rate is, then you're taking on a risk that makes no sense. And if we look at CBA as a case right now, the yield's around 3%. When the RBA cash rate's 4.1%, why would you be buying CBA if you're a yield investor? Because you're basically getting a 1% lower return and you're taking market risk. And that's something that we would look at and say, we really haven't been buyers of CBA over the last 6 months because of those reasons. With this pullback that we've seen in the banks in the last week or two, the other banks, ANZ, NABs and Westpac, have started to look attracting on that sort of matrix. So that's where we start to look at those sort of things and those sort of traps that could appear.
What about franking credits? Do you factor that into the equation as well?
Yeah, definitely. We'd be looking at a grossed up yield. But I suppose if you're comparing against a straight cash rate, then we definitely would look at that franked up or grossed up yield to compare. And then if you take that in that CBA example, you're probably buying CBA at maybe slightly above the cash rate, where I think really with the cash rates, and we're currently 4.1%, I wouldn't want to be buying any bank at under about a 5.5% yield because I have market risk within there. So they're the sort of factors that we'd really focus on.
So when you say market risk, that's the price could also go up and down as well. Is that how you factor that into the equation that you're thinking about with a bank share like that?
Definitely. Yeah, with any stock, you've got to consider market risk, and obviously market events occur. One of the things people sort of look at with banks, you remember they lend money, and lending money is a risky business. Now, our banks in Australia are very, very good at managing their lending risks, but they do sometimes lend to people, and certainly some of their corporate lending over many years has been a bit poor, and that's where they get trapped. So you've got to really understand what sort of environment the market is or the economy is in when you're looking at banks as an investment.
And you mentioned yield, and that's dividend, isn't it? That they're interchangeable terms, aren't they?
They definitely are, yes.
So what are some of the common themes that you see people wanting to invest their money in the share market? And I also should point out that this question could have a subtext of what are the misconceptions people have about investing in the share market when they come to you?
Look, that's an interesting one. I suppose you'd look at, for investors coming into the market, is understanding that it is a medium to long-term investment in most cases. We really are not a get-rich-quick scheme. And if you're chasing that, then I think you're going to be disappointed. I mean, some people do have that sort of success and will make quick profits. But I think for the average person coming into the market, looking for a medium to long-term return is the focus. Probably no different to property. You don't sort of jump in and buy a property and expect to sell it in 2 months' time. You've got to look at that longer time frame. So the share market really is no different. The main, I suppose, benefit of the share market is your ability to diversify. You can look at different shares in different sectors. And then if a sector is underperforming, certainly you can move out of that sector into another sector of the market while still remaining an investor in the share market as such. And that's where I suppose there's so many fantastic products we have now that can offer us a broad range of investments through one single vehicle, something like an exchange traded fund, or some of the portfolio management services. We've got one we offer which lets a professional pick investments for you and they manage the portfolio accordingly. So there's lots of those sort of products around, but also for any investor that is coming to the market, I think you've got to take a 3 to 5 year view as a minimum if you want to be an investor.
And do you find people actually coming along and going, what sort of company should I buy? Thinking that it's just going to be one stock that's going to make or break their portfolio?
Yeah, definitely. And they're generally people that have had a tip from someone that, given them, a bloke at the pub said, oh, you should buy this stock. And they're just focused on that rather than looking at investing as a whole sort of environment where you've got to consider lots of stocks and lots of sectors in the market and, not sort of putting all your risk or all your eggs in one basket, as the saying is, looking to manage your risk and understanding that spreading your exposure to the market is a great way to build a portfolio.
You mentioned sectors just a minute ago.
Yep.
Does that mean that you sort of look at a sector before drilling down into any particular company?
Yeah, look, definitely we would. So we might look at our view on resources, and then it may be a certain type of resource. Obviously, iron ore is a very big subject for Australian companies, with a couple of our majors being heavily involved in the iron ore sector. So then if you're looking at iron ore, then you've got to be looking at Chinese growth numbers because you've got to be looking at steel exports out of China. So you sort of look at those factors first, and then you might sort of drill down and say, well, if you're liking the iron ore sector, which of the major 3 iron ore companies would you look at exposure to? BHP, Fortescue, or Rio? They all have different parameters around them. That would be how we would work through any recommendation around an iron ore stock. So that might be our sector analysis there.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Okay, let's turn to derivatives and options.
Yeah, sure.
What are exchange-traded options?
Okay, well, so there's two classes of options that we trade in the Australian market, a call option and a put option. I think the simple way to explain a call option, if you buy a call option, you're basically locking in a price that you can buy the stock at over a certain period of time. So you can, as the buyer of a call, you can call the stock from someone, so you can make them sell you the stock at a set price. Now, if we reverse it and look at a put option is basically you're locking in a sale price for the stock. So if you owned some shares in, say, BHP and wanted to make sure you could sell them at, say, $39 over the next 6 months, by buying that put option, you can lock in that price that you can sell the shares to, or put the shares onto someone is a good way to think of it, at that $39. So call options you would buy if you think the market's going up. Put options you would buy if you own the stock and you think the market may fall, and that locks in a sale price for you. So that's a put option could be considered an insurance for an owner of a share, where a call option is a cheap way to get exposure to a share if you think the share is going to run up.
So who uses options? Well, in terms of your clientele, obviously, you can't talk about everyone in the broad market, but who are the kind of people that would benefit from using options?
Look, options, it's an interesting one. It's certainly institutional investors in Australia use options a lot, and so do many of our big funds and professional investors. But really, for retail investors, options are actually a fantastic tool once you understand the benefits and the advantages of using them. If I can sort of jump into explaining a great strategy, which I think will help explain what sort of clients could use the option market, one of the questions you had for me today was regarding a sold put option. And this is a great strategy for someone who wants to build a portfolio. We'll take a fictitious number. Let's say we had $100,000 we wanted to put into a particular stock. Might be sort of looking to buy 2,500 BHP shares at around about $100,000. So rather than going in the market and buying those shares at say, $40, where BHP is trading at the moment, we could look at selling a put option to buy those shares at, say, $39.50, so a little bit cheaper than the current price. Now, by taking on that liability, we're going to get paid a premium to accept the liability. So we might get paid 50 cents a share. So over our 2,500 shares we exposure, we're going to get paid a bit over $1,000 in premium. If BHP shares are above $39.50, we get to keep that premium when the option expires. If they're below $39.50, we would be forced to buy the shares. If you take our $39.50 as the price we're buying it at, we've already got 50 cents in option premium. So really we're buying the shares at $39. So it's a great way to look at getting into a stock cheaper rather than going in now and buying the share at $40. So that's a great strategy for clients that want to start building a portfolio, not in a rush to do it, but want to look at ways to maximize or minimize their costs, I suppose would be a great way to look at it, of entering into certain stocks. So that's something I do for a lot of retail clients. And a lot of clients, said we're starting to build portfolios, and this is a trade we look to do to build that portfolio. You can't do it on every stock, but there's about 60 odd stocks that we could enter this strategy on, and they'd all be stocks that you could consider in a portfolio. So the sold put's a great strategy for a new investor.
Yeah, it's interesting to cover something because there's millions of option strategies, aren't there? That you can undertake, and you kind of get lost in it. And one of the things also people get lost in is that idea of what your responsibility is. That you have the right, but not necessarily the need to buy or sell that particular company when it expires.
Yeah, definitely. Look, and understanding how you'd manage liabilities and obviously how you can reverse the liability. If you have got a sold option, how you can reverse it if you want to change your mind or the market's moved in the right direction for you, you can always take a profit and close position whenever you want. So there is lots of ways of managing it. But for clients that just want to look at buying, as I said, that $100,000 worth of shares, that simple sold put, and we'd call it a sold covered put because you'd have to have the funds available to buy the stock, then you're actually taking on less risk than the average investor who just jumps in the market today and buys the $100,000 worth of BHP. The sold put option, if you've got the cash to cover it, is a lower risk strategy. something that really, I think our market, we have struggled with our education around options. This is something where I'd love to see more retail clients consider this as a trade rather than just being a straight out stock buyer, looking at what is a lower risk strategy. If they have the capital to do the trade, this is really something they should be considering.
And that's really important to understand. It's not a free ride. You actually do have to have the capital ready there to put up in case. Otherwise, it becomes a naked situation, which no one actually wants to be in.
Very true. And that's something, if you've ever read about any of the classic sort of blow-ups that have happened in option markets, and many professionals and fund managers around the world have blown themselves up utilising options, but it would be where they've taken on leverage above what their capital is. So it's a real key point is make sure the exposure you have is an exposure you can meet. And that's why we would say if you have that 100,000 that you're prepared to put into a particular stock, then the idea of that BHP put would be a great one to consider. But yeah, just knowing you've got your liability covered is really a key to that.
There's also a time component involved, isn't there? Explain how that works.
Yeah, certainly. So generally options are listed up to about 12 months out with possibly a monthly expiry. We even have weekly expiries now in the Australian market, but it'll depend on, you can choose what length of time you want exposure to. So you might say that in our BHP example, you're happy to take exposure out to say May. So you would say, well, I'm happy to sell a put, say a May 39.50 put. And so that means your exposure runs to the May options expiry, which is about the 20th of May. So that's where the time component comes in. The more time you sell, obviously the more premium you'll receive for the same option strike, but then the longer period you've got exposure for. So you've got to sort of weigh those factors up. We would generally say 45 days is probably a good sort of time frame. If you are selling an option with the intent of buying the stock, that's probably where we'd sort of look as the sweet spot to enter that transaction.
And with the sold put option strategy, there's also the downside that if your strike price is $39.50 and BHP drops down to $38, that you will end up buying at that $39.50 price.
Correct, and absolutely that. And so you've got to look at the stock that you're looking to enter this option strategy around that is a stock you want to buy. If you're prepared to buy BHP at $40 today, then this strategy could be one you could look at, because the worst case scenario is you're going to be buying the stock anyway, which is a strategy, or which is an investment you're happy to make. You don't do this on stocks that you don't feel you'd like to own.
Yeah, I mean, that's a really important thing to understand about it, isn't it? That you've got to actually be laser focused on what your goals are in that long-term 3 to 5 year period, don't you?
Definitely, and you'd want to be confident that any stock we are looking to buy, we've done our research around, we're comfortable with the level we'd happily to buy the stock at, and that's where we could then look at basing an option strategy around our investment view.
Because many traders will actually just buy and sell the call and the put options without any intention at all of buying or selling the underlying stock.
Yeah, very true. So that's probably the more active part of the market. And there's people that will speculate, buying calls or buying puts based on their view of a potential move in the underlying stock. And that's fantastic. The trading part of the market is very important. What we're talking about here is more someone who's got an investment view of the underlying.
Okay, let's talk about a couple of other strategies, option strategies. And we've got the collar, which is an interesting one, which I hadn't heard about before. But first of all, the covered call. That's one of the most basic kind of option strategies, isn't it?
Look, it definitely is. And it's something, again, I think very underused in the Australian market. We really should be doing more of this. So for anyone who owns a stock, and we'll jump in and do ANZ as our example now, the stock's sitting around about $29.50. If you were looking to gain some extra income against your ANZ shares, you could look at selling a call option at, say, the $30 strike. So about 50 cents above the current share price. Basically what you're doing is you're giving someone the right to buy your shares off you at $30, and they're going to pay you a premium for you accepting that obligation. If the stock remains below $30, then you just get to keep the premium you've received. If the stock goes above $30, then your liability would be you'd have to sell the shares that you own at that $30 price, bearing in mind you've also got some option premium along the way. So you might actually get $30.30 or something like that when you base it on the premium you received. So it's a great simple income strategy.
Yeah, but you have to actually understand that you are obligated to sell if it goes in the money, aren't you?
Yeah, definitely. And that's something you've got to be confident or comfortable that price you would sell your ANZ shares at. If not, then the covered call can still work, but you may need to be wary that you may have to buy the position back at expiry to avoid that stock sale. So that could work out whether you make a profit or not.
I just use that term in the money. So can you explain in the money, out of the money, and at the money,
Yeah,
which is
sure.
also
So
important concepts in the option strategy market?
definitely, Phil. So at the money obviously means a strike that is at or basically equivalent to the current share price of the stock. Out of the money will be, in the case of a call option, it'll be a call option that is above the current share price. And in the money would be, in the case, again, of a call, would be an option strike that is below the current share price. In put options, obviously reverse that. An in the money put will be above the current share price, and an out of the money put would be below. Obviously, the out of the money is the same in both concepts.
And that also has a bearing on whether the option will be exercised. Can you explain exercising an option?
Yeah, certainly. So we'll continue with the ANZ example. So if we've sold our call option over our ANZ shares, and let's say we've gone out to the end of April, if at the end of April our ANZ shares are, say, at $30.50, and we've sold a call at $30, that call's obviously in the money. So the person who bought that call from us is going to want to purchase the shares at $30 from us because they're trading at $30.50. So they're well above the strike price. So that in the money position would be exercised at or near expiry.
So theoretically, someone who's held their ANZ shares for a number of years and they've been collecting the dividends, they're going to be sitting on, some nice capital growth, hopefully, presumably.
Yes. Yeah.
Maybe not with the banks so much as other companies. But then they would say, okay, well, that's great. If I have to sell, that's fine. I'll just lock in the capital gain. But then they've got to make the move into another stock, and then they can use the sold put option before actually even doing that, thus hopefully multiplying gains.
Yeah, and look, I've got a lot of clients that would run that exact sort of strategy. They basically sell the put option, enter the stock, write a covered call against the stock once they do buy it, and then if they lose the stock through the covered call, then we look to jump back into whether it be the same stock or another stock with a new sold put option. So basically, they're trying to keep the stock always or the capital always working, whether it be through holding a company and having a call sold against it, or being in cash but having put obligation against that cash. So trying to keep that exposure in place. Obviously, there's dividends along the way. They'll try and pick up a dividend. We're looking at stocks from an investment point of view. So generally, they'll be looking at something with a decent dividend return, and utilising the option market to sort of the in between periods from when dividends are being paid, trying to make sure we're getting some earnings along the way there.
I think it's really important to emphasise, though, that you do have to have a very much an overall strategy. It's very easy to become addicted to options and what they can offer, but you've always got to be thinking 1 or 2, 3, 4, 5 steps ahead, don't you?
Yeah, certainly focusing on what you're looking to achieve, and I suppose looking for stocks that are going to enhance the overall portfolio based on the dividend returns, but also what option premiums are being offered. Telstra is a stock that has very little volatility, so it has very little to offer in the way of option premiums, where Fortescue is a far more volatile stock, so has much more option premium when we're looking at sort of the same dollar exposure of positions. So focusing on that sort of thing, focusing on what dividend yield you're getting and what is the right mix of stocks for your portfolio.
Okay, let's move on to the collar. I love the names of these option strategies. When you go through them, there's a million of them with highly creative names, aren't they? But
they certainly do, yeah. So collar's a pretty simple one. It is basically, it's a protection strategy. So it's basically where you buy a put option. So you buy the right to basically sell your shares. So it's like insurance for your shares. And then to help fund the cost of buying that put option, you sell a covered call. So it's two trades. So we can use the ANZ example. We own the ANZ shares. We sell a $30 call to get some premium in, and we buy a $29 put to insure our shares. So you've basically capped your downside, but unfortunately you've also capped your upside. We really want to try and do these trades when we do them for a net credit. So we want to sell the call option for more than we're paying to buy the put option. Otherwise, it's costing us to set the collar up. So we call it a zero cost collar is obviously the sort of one of the terms, but if you can do them for a credit, that's fantastic. But obviously you really don't want to be paying to do a collar, because otherwise if you've got that sort of more of a negative view, then there's better strategies we could look at running.
Yeah, you mentioned the concept of protection, and a lot of the larger institutional fund managers, they will be protecting the downside risk by buying put options, aren't they? So this is a way of doing it, but it's very difficult maybe to do that with a smaller portfolio.
Yeah, look, it definitely is. So obviously If you haven't got a huge portfolio, then definitely the collars, while it will still work, there's probably more simple things. Maybe an index put option could be better if you've got a portfolio of a couple of $100,000 spread over sort of top 200 companies. Then looking at index options could be another alternative. Just buying an index put might be the best transaction versus trying to do a collar on each of the individual holdings you have.
So many people, myself included, have run into trouble trying to trade options. How can these dangers be minimised?
I think the key is understanding your risk. And that's why everything we've talked about today is being based off someone having the capital to meet any liabilities they're taking on. If you are going to look at positions that are greater than your capital abilities, then you really are running into what we call naked trading. And as I said, every sort of classic blow up that's ever happened in the option market will involve someone having leverage above their capability. If you can manage it and only keep your leverage to, or your exposure to what your capabilities are, that you can buy that stock in, no matter what, you've got the capital there, then you're not taking any greater risk than a standard equity investor. And I think that's the key. You can make income in the option market quite easily. It's managing your exposures and making sure that, the classic one is make sure you can sleep at night, that your exposures aren't causing you concerns because you know you can meet what you've got. Then I think the option market is something that more and more people should be looking at.
Yeah, downside risk. It's something everyone should be looking at in any phase of the share market.
Yeah, definitely. And I think with the current political climate, I think definitely having, understanding what sort of insurance and what sort of hedging you could do for portfolios, but also understanding how times like this when volatility is starting to return to the market can be great opportunities for option traders because premiums can jump quite a bit. And that can be when we, as option traders, and I do this for myself, can look for greater chances to pick up good premium on stocks that we'd like to own. BHP, classic example, I'd be happy to sell some puts in BHP for myself right now. If I could buy it around $39, I'd be very happy. So I might be able to get a quite large premium versus what I was getting 6 months ago because we're seeing more volatile environment.
What kind of shop is it that you run? I mean, just explaining it to investors because people are used to online brokers, ComSec or whatever, NabTrade, or financial advisors. Are you kind of straddling the world in between?
Yeah, look, we're probably the classic old school broker. We're focused on picking stocks, providing recommendations. We generally focus on general advice these days. The full service stuff is we leave to financial planners because of the requirements around that. So, look, I can explain probably the easiest way to say, look, iInvest is an old school broking firm that focuses on building portfolios and making stock recommendations to investors.
Are there many of you guys around?
I don't think there's a lot left. I think it's most of them have gone to down that planning road and obviously charge fees more around that sort of service of a portfolio management service where we're more that traditional broker still.
Are many of your clients running their own SMSF?
Yeah, definitely have quite a lot of clients that are utilising super fund SMFS trading and utilising options within that. Protecting the portfolios within super funds is obviously become very popular, but also income-related strategies. So covered calls, definitely a big one for self-managed super, and just a general portfolio building focus.
Oh, interesting. No, it's just always good because talking to old school brokers really do give you insights into the market that a lot of other, fund managers don't really give you.
Yeah, and look, I think really that's a real laziness if we're off record there. It's a real laziness.
No, we're totally on the record here.
It is a real laziness of many of these offerings. They'll pick 6 ETFs and put you in those, and so that's where it is. We're still more of a stock selection process.
Generating alpha, as they say in the industry.
That's it. Yes, that's it.
How have the returns been? I mean, can you speak to that?
Look, it's a really hard one to say because so many clients run such different portfolios. When we're looking at setting up one of these type of things where we're utilising covered calls and the sold covered put strategy, we would generally try and say that if we can double what the dividend yield would be on the underlying stock, that's probably a simple way to consider it. But markets do what markets do, and so you can never really sort of give any guarantees around that. It's more that's a good idea of what we'd like to see clients achieve.
Would you consider your clients to be more sophisticated style investors that actually understand a bit more about how markets work and that they want to be involved on a daily basis?
I think they build into that. Many people will come into and talk to us about strategies and building a portfolio. And as we educate them on the power of options and its uses, then their understanding grows and their level of sophistication and understanding of the market really increases. So it's really can build over time. And once you're doing a transaction and you're in the trade, if we've sold a put and we know we're going to have to buy the underlying if it gets exercised, the client really starts to get a feel for how it works and understanding their risk requirements and the liabilities and the reporting components, all those factors sort of start to make sense.
So if listeners want to find out more about iInvest, where can they go?
Yeah, certainly jump on our website, iinvestadvisory.com, or check us out on socials. We certainly are pretty active there. And I'm sure myself or one of my team would be more than happy to talk through what we offer and maybe how options could be a good tool for any new investors.
Yeah, you are active on the socials, because that's how I came across you guys with Georgia, who works with you, making some comments on my Shares for Beginner Facebook group chat page. And,
excellent.
Please encourage her to do a bit more.
I will indeed, Phil. Yeah, no problem. I'll talk to her about that shortly.
Haydn Froggatt, thank you very much for joining me today.
Thanks, Phil. Catch up soon.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.